The fractional reserve banking system in the United States enables commercial banks to create money ex nihilo, a process that fuels economic expansion but raises concerns about unchecked financial power. When a borrower secures a loan, such as $100,000 for a home or $1 for a purchase, the bank credits their account, generating a deposit that expands the M2 money supply, valued at $21.97 trillion in January 2025. This deposit, treated as new money, circulates through transactions, potentially returning to the banking system to support further lending. The Federal Reserve, an independent entity governed by a presidentially appointed board, regulates this system, ensuring banks maintain stability through capital and liquidity requirements. However, the absence of a fixed cap on money creation allows banks to amplify the money supply through loan-driven deposits, constrained only by regulatory oversight and borrower demand. Critics argue this system, rooted in debt-based money creation, prioritizes profit over stability, as banks profit from interest while expanding credit with minimal tangible backing. The national debt, at $33.89 trillion, exceeds the money supply, highlighting a disconnect between government borrowing and circulating currency. This essay examines the mechanics of money creation, the Federal Reserve's regulatory framework, the role of deposits in lending, and the implications of an uncapped money supply, asserting that the system's permissiveness fosters economic volatility. By analyzing these components, it critiques a structure that empowers banks to generate wealth from nothing, questioning the sustainability of a debt-driven economy. The exploration reveals a financial architecture where money emerges from promises, regulated yet unbound, shaping the nation's fiscal landscape with profound consequences. Part 1. Mechanics of money creation. In the fractional reserve banking system, money creation occurs when a bank issues a loan. A borrower signing a promissory note for $100,000 triggers the bank to credit their account with a deposit, instantly creating new money. This deposit, part of the $21.97 trillion M2 money supply in January 2025, represents no pre-existing funds but a ledger entry. The bank records the loan as an asset and the deposit as a liability, embodying ex nihilo creation. This process, authorized by the bank's license, relies on the borrower's promise to repay, secured by collateral like a house. The created money circulates when spent, such as paying a seller, who may deposit it elsewhere, enabling further lending through the money multiplier. Historically, this mechanism has driven economic growth, as loans for homes or small purchases like $1 for gum add to the money supply. Yet, this system's reliance on debt as the foundation of money creation invites scrutiny. Banks generate wealth without tangible reserves, profiting from interest while expanding credit. The absence of a requirement to hold substantial pre-existing funds underscores the system's permissiveness, allowing banks to amplify money supply with minimal constraints. Regulatory oversight, while present, does not cap this creation, as banks meet capital and liquidity standards to ensure stability. Critics view this as a structural flaw, arguing that creating money from promises risks over-leveraging, where economic bubbles form from excessive credit. The mechanics reveal a system where banks wield immense power to shape the money supply, raising questions about accountability and the long-term stability of an economy built on debt-driven financial alchemy. Part 2. Federal Reserve's regulatory oversight. The Federal Reserve, established by the 1913 Federal Reserve Act, regulates banks to ensure stability in money creation. Governed by a 7-member board of governors, appointed by the President and confirmed by the Senate, the Fed operates independently, overseeing 12 regional banks that supervise commercial banks. Banks creating money through loans must comply with capital adequacy, liquidity, and risk management standards, enforced through examinations by the Fed, OCC, and FDIC. Capital requirements, such as Basel III's 8% Tier 1 capital for a $1 million loan, ensure banks absorb losses. Liquidity rules mandate sufficient reserves to settle transactions, though reserve requirements dropped to 0% for many banks in 2020. The Fed monitors banks via financial reports and stress tests, ensuring they remain in good standing to create deposits ex nihilo. This regulatory framework, while robust, permits expansive money creation, as banks need only meet minimum thresholds to lend. Critics argue this leniency empowers banks to generate vast sums, as seen in the $21.97 trillion M2 money supply, without hard limits. The Fed's independence, insulated from direct presidential control, shields it from political pressure but fuels skepticism about accountability. By enabling banks to create money from borrower promises, the Fed facilitates a system where debt fuels economic activity. This structure, while stabilizing banks through oversight, prioritizes growth over restraint, allowing money supply expansion driven by loan demand. The regulatory system thus balances stability with permissiveness, fostering a financial environment where banks wield significant influence over the economy, raising concerns about unchecked credit creation and its potential to destabilize markets through over-leveraged lending practices. Part 3. Role of deposits in expanding lending. Money creation's impact amplifies when loan proceeds return as deposits. A $100,000 loan creates a deposit that the borrower spends, such as paying a house seller. If the seller deposits this sum in the lending bank, the bank gains a $100,000 liability, enabling it to lend $90,000 more under historical 10% reserve rules, though requirements are now 0% for many banks since 2020. This money multiplier effect expands the $21.97 trillion M2 money supply. If the seller deposits elsewhere, the original bank gains no new lending capacity, but the banking system benefits. Banks incentivize deposits through high-yield accounts or bonuses, a strategy termed deposit mobilization or relationship banking, to maximize lending and interest income. The loan itself, recorded as an asset, does not directly enable more lending. Only deposits fuel further loans. This dynamic reveals a system where banks profit from creating money and recapture it as deposits, perpetuating a cycle of credit expansion. Critics argue this structure incentivizes reckless lending, as banks seek deposits to amplify profits, unconstrained by a money supply cap. The permissiveness of fractional reserve banking allows banks to generate wealth from borrower debt, with regulatory oversight ensuring stability but not limiting scale. When loans are repaid, the principal destroys money, yet banks continue lending based on new deposits, sustaining growth. This reliance on debt-driven deposits underscores a financial system where economic expansion hinges on continuous borrowing, raising concerns about sustainability. The ability to create and lend against deposits empowers banks, but the absence of strict limits fuels skepticism about long-term economic stability in a debt-dependent framework. Part 4. Implications of an uncapped money supply. The absence of a fixed cap on the money supply in fractional reserve banking enables exponential growth but invites instability. Loans, whether $100,000 for a house or $1 for gum, create deposits, expanding the $21.97 trillion M2 money supply as of January 2025. This growth depends on borrower demand and bank capacity, constrained only by capital and liquidity regulations, not a predetermined limit. The national debt, at $33.89 trillion, exceeds M2 because debt accumulates from government borrowing, while money supply reflects circulating currency and deposits, reduced by loan repayments. When borrowers repay loans, principal is destroyed, contracting the money supply unless new loans replace it. If borrowing slows, as during economic downturns, the money supply shrinks, amplifying volatility. This uncapped system allows banks to create money ExNihilo, profiting from interest while fueling economic activity. Critics argue this permissiveness risks over-leveraging, as excessive lending can inflate asset bubbles, evident in historical crises. The Federal Reserve's policies, like low interest rates or quantitative easing, further enable money creation, yet fail to address the systemic reliance on debt. The disparity between national debt and money supply highlights a structural flaw. Government borrowing outpaces circulating money, burdening future generations. This debt-driven system, while facilitating growth, prioritizes bank profits over economic restraint, fostering a cycle where borrowing sustains prosperity. The lack of a cap empowers banks to shape the economy, but without stringent limits, it risks instability, as unchecked credit creation amplifies economic swings. The system's design, rooted in debt, underscores a precarious balance between growth and vulnerability, demanding scrutiny of its long-term consequences. Conclusion. The fractional reserve banking system, enabling banks to create money ExNihilo, embodies a powerful yet flawed mechanism driving the U.S. economy. Loans, from $100,000 mortgages to $1 credit card purchases, generate deposits, expanding the $21.97 trillion M2 money supply without a fixed cap. The Federal Reserve's oversight, through capital and liquidity rules, ensures bank stability but permits expansive lending, prioritizing growth over restraint. Deposits from loan proceeds, if recaptured, fuel further lending via the money multiplier, amplifying bank profits and economic activity. Yet, this debt-driven system, where money emerges from borrower promises, raises critical concerns. The national debt, at $33.89 trillion, surpasses the money supply, reflecting cumulative borrowing unmatched by circulating currency. Loan repayments contract the money supply, and reduced borrowing could shrink it further, exposing economic fragility. Critics assert this permissiveness empowers banks to generate wealth with minimal tangible backing, risking bubbles and instability, as seen in past crises. The Fed's independence, while shielding policy from political influence, limits accountability, allowing banks to dominate financial creation. The uncapped money supply, fueled by relentless borrowing, sustains growth but burdens the economy with debt, questioning its sustainability. This system, rooted in profit-driven lending, prioritizes short-term expansion over long-term stability, creating a precarious financial landscape. Reform is needed to balance money creation with stricter limits, ensuring economic resilience without sacrificing growth. The unchecked power of banks to create money from debt demands re-evaluation, as the consequences of an over-leveraged economy threaten future prosperity. Addressing this imbalance requires acknowledging the system's inherent risks and imposing constraints to safeguard against volatility.